Hey everyone, welcome to your Algo Lab. In our last episode, we explored optimizing long-term moving average strategies using grid search. If you haven't seen it yet, we highly recommend checking it out. The links to the previous episodes are in the description below. Today we're going to backtest the same strategy across all asset classes. Our goal is to thoroughly test the long-term moving average strategy to see if it can outperform the buy and hold approach. If you like our channel, make sure to like, subscribe, and hit the bell icon to stay updated with our latest content. Without further ado, let's get started. Let's begin with our fixed income asset class. We focus on the 10-year government bond prices, excluding coupon income to avoid distorting the moving average calculations. We cover bonds from the US, Canada, Germany, France, Italy, UK, Japan, and Australia. For each asset class, we'll present the backtesting results in 3 steps: return, risk, and risk-adjusted return. Regarding absolute return, long-term moving averages do not perform well on bond prices. Only 2.5% outperforms the benchmark. This is partly due to the extended period of decreasing interest rates, which has created a prolonged bull market with no significant bear markets. Consequently, the retracements are minor and can be seen as mere pullbacks within the bull market. This leads to numerous false signals when bond prices touch the moving average and then revert back to the bull market trend. In terms of risk, although the strategies reduced the maximum drawdown, 72.5% of them outperformed the benchmark. However, the magnitude of this outperformance is not particularly significant. Moving on to the risk-adjusted return, we observe that only 15% of the strategies outperformed the buy and hold benchmark. It is entirely normal to encounter strategies that do not work. It's part of the process. In this channel, rather than selectively choosing specific indicators with specific parameters on specific assets, we aim to present the most transparent backtesting results across all asset classes. Even if an indicator does not work, we will analyze why it fails and explore ways to improve it or determine if it should be avoided altogether. Moving on to commodities, we've chosen to use spot commodity prices. This is similar to using stock index prices without dividends or bond prices without coupons. The actual investment return will differ, which we will discuss in detail in later episodes. For this episode, we are focused on the long-term trends of commodities and do not want the calculations to be distorted, so we use the spot prices. We classified commodities into several categories based on their distinct price behaviors. Agricultural commodities include sugar, soybeans, corn, and wheat. Industrial metals encompass copper and aluminum. Precious metals comprise gold and silver. Petroleum commodities include Brent crude oil, gasoline, and heating oil. Let's begin with returns. Agricultural commodities show very disappointing absolute returns, being negative across all parameters. This aligns with the various factors that influence agricultural commodities, such as weather conditions and supply and demand. These specific factors cause short-term sharp fluctuations which trap long-term moving averages. Industrial metals present a very different picture, possibly due to their strong connection to economic activities. Precious metals, however, do not perform well in terms of absolute returns. This can be attributed to various factors influencing precious metals, such as their role as an inflation hedge, safe haven, and real interest rates. Petroleum commodities demonstrate only some outperformance over shorter time horizons. Turning to the risk aspect, we observe an overall reduction, though it is not particularly significant. Agricultural commodities fare the worst, showing an increase in risk. Notable reductions in risk are seen in industrial metals for parameters of 200 and above, while the others generally provide only marginal risk reduction. Moving on to the risk-adjusted return, industrial metals are the only commodity asset class that consistently outperforms when the parameter is 100 and above. This consistent outperformance can be attributed to the close connection between industrial metals and economic activities, which results in identifiable long-term trends. For Forex and cryptocurrencies, each currency is treated as an asset. The US dollar value is represented by the dollar index, along with all major currency pairs against the dollar. Similar to other asset classes, we are using spot prices here. While roll costs do affect currency holding returns, we will take care of those details in future analyses. In today's video, we focus on long-term trends using spot prices. As usual, we start with absolute return. Here we observe overall outperformance compared to the buy and hold benchmark strategy. For cryptocurrencies, there is significant improvement over our benchmark across all parameters. Next, we examine risk, noting an overall improvement across nearly all currency pairs and cryptocurrencies. Examining risk-adjusted returns, we see notable improvements, especially with cryptocurrencies. For instance, the 100-day moving average nearly doubled the risk-adjusted return for the crypto asset class. Let's wrap it up. Over the past 3 episodes, we have backtested the long-term moving average and grid search optimization across nearly all asset classes. Here are a few key takeaways from our findings, with a focus on the averages for each asset class. Regarding absolute returns, the long-term moving average does not seem to deliver satisfactory results. Only 14 out of 40 strategies, or 35%, outperformed the benchmark. In terms of risk, the long-term moving average appears to provide an improvement over the buy and hold strategy, with 34 out of 40 or 85% strategies outperform the benchmark. In terms of risk-adjusted returns, 20 out of 40 strategies, or 50%, outperformed the benchmark. For long-term moving average strategies, there appear to be valuable additions in risk-adjusted returns for equity indices, industrial metals, Forex and cryptocurrencies. The parameter range of 100-200 seems to be generally acceptable. Overall, the results are not bad, especially considering that further optimization and variation have not yet been applied. However, we believe there is still room for improvement. Although we don't have a very conclusive answer, we're just at the beginning of our journey. In the upcoming episodes, we'll explore other long-term trend indicators and their variations. Don't forget to check out our other videos. If you enjoy our content, please like, subscribe, and hit the bell icon to stay updated with our latest releases. Thank you for watching, and see you next time.